Aaron is with us in Denver. Hi, Aaron. Welcome to the Ramsey Show.
Thank you, sir, for having me. Long-time listener. You've helped me get through a lot of stuff in the past, and hopefully you can help with the situation I'm in now.
Thanks. How can I help today?
Yeah, so 30 years old, me and my wife, we're looking at selling our house. As you know, the market here in Denver is pretty crazy. We've got some pretty solid equity in the house we have currently, upwards of $300,000. Looking to buy a new house, and we're given a couple options from the lender that we're working with, and one of them I'm extremely unfamiliar with. I've owned several houses, traditionally done just a fixed interest mortgage. They're offering me what's called an all-in-one loan, and I just was curious if you've ever heard of that. Good, bad situation. What do you have to say?
I've not heard of it. It does sound like a brand particular to that lender. What does it entail?
So how they're marketing it is it's basically a savings account that the balance in the account reduces the interest by that amount. So, we have about $50,000 in cash that we keep in the account at all times. So that would basically reduce the interest that's charged on the account. The thing I don't like about it is it's a variable interest rate. Right now it's around 3.5, versus I can get a 1.99 on a 15-year fixed. But it has potential to go up from there. It's kind of a sliding rate. So the math, they provided me a spreadsheet that said it'll save $50,000 over the life of the loan or something, something like that. But it's just kind of a new territory to me.
Yeah. If you put the $50,000 as an extra down payment on the house and you get out of debt that much faster, you're going to save a lot more than their spreadsheet gave you.
That's what I figured. I'm an engineer, so I'm pretty good with math, and I've tried to run a bunch of different scenarios, and it ends up being a wash, basically.
And here's the other thing. Here's the other part of that is there's a part of the math that's hard to put in there, and it's the analysis of risk. That the more debt you have on the house, obviously the higher your payment is, and so the more risk you have. The longer you're in debt, the more risk you have, and the higher the ratio of loan to value is, the higher your risk is. And that it's hard to put that to an actual math figure, but that's common sense. We know that to be true because you and I have walking around sense, right? We know that if I owe more money, I have more risk. Duh. So. But it's hard to actually put an actual dollar figure to that. The way we do see that play out in reality and where we can measure it is like when we did the Ramsey team did our Ramsey research study on millionaires, and we studied 10,000 millionaires. We didn't find a single one that used a technique like you're talking about to become wealthy. Not one.
Correct.
Instead, we found the typical millionaire. All the data tells us that the typical millionaire quickly gets out of debt. Average pays off their home in 11.2 years. Which means some do it sooner, some do it longer. But that was the average among the 10,000 millionaires. None of them were sitting around going, I'm going to figure out a way mathematically to borrow my own money back and pay a little higher interest rate on a variable, and spreadsheet says, and all this crap that they're telling you, right, with this product.
Right.
So this product stinks to high heaven, dude. Run from it. Bottom line. You knew it. You could feel it in your bones, but you hadn't been able to figure out a way to put a math number to it yet. But I just gave it to you. Data says don't do it. This is the Ramsey Show.